Okay, you're welcome to today's lesson. In today's lesson, we are going to be looking at one very important topic, though it's a subtopic under partnership account. It's called how to prepare partners capital account. I want to say that again, how to prepare partners capital account. Meanwhile, before we make progress, I would like to encourage that you should go back to videos to check for partnership account. That's where you appreciate the definition we have given. We've looked at the introductory part of partnership. We've looked at the definition of partnership. We've looked at what we call partnership deeds. We've also looked at the content of partnership deed when there is a written agreement between the partners, and then what is actually obtainable when there are no written agreements. And we've also looked at the types of partners, and then we look at the accounts that are required to be prepared by partners. So, but in today's lesson, we want to now look at how to prepare partners capital account. So if you are seeing this video for the very first time, we recommend that you go back and search again for partnership account. So by the time you've been able to understand all of that, today's lesson will be very simple for you to understand. All right, let's quickly make progress. Having said that, we want to look at what I call our goal map for the lesson, or what I call our compass, or the goal or the focus of our lesson. Those things that will guide our interaction. We are not just moving aimlessly. We have a target. We have where we are going. And those things that will serve as a guide or as guide to where we are going constitute our lesson objective. Number one, we will describe the types of capital maintained by partners. What kind of capital? What types of capital account do partners maintain? And then we'll also look at how to calculate interest on capitals. And then we'll also define what drawing is all about, and we'll calculate the interest on drawing, and we will solve related problems from the exam guide. Okay, let's quickly start. Now, the types of capital that is prepared by partners. Capital may be introduced by some or all the partners, and this will be credited to the capital account. The partnership can maintain any of the following. Now, in the partnership business, the money that is introduced by partners to start up that business is what we call capital. The money that is introduced by the partners of that business constitute what we call capital. And that money is not just introduced and kept somewhere in the company. That money must be in an account. So when the partners introduce this money, they must open account. Now, what we are saying is that two types of account can actually be kept or be maintained by these partners. Number one, we can have an account that is without a current account. That is the account we call fluctuating capital account. It is called fluctuating capital account. The partners can say, let's not worry ourselves and begin to open different accounts in the bank. Let's just maintain only one account without a current account. And then that means that the account is actually maintained by, the account maintained is just a capital account without current account. We can also have one that is just fixed capital with current account. We have one that is open for our fixed capital, and then we have one that is open for our current capital. Let's explain them one after the other for easy understanding and assimilation. Number one, capital without current account, otherwise called fluctuating capital account. I say that again. Capital account without current account, otherwise called fluctuating capital account. This capital account represents a mixture of capital and undrawn profit. That is to say that we just open a particular account for individual. Let's assume we have 3 persons that are involved in the partnership business. We have Peterson, we have Betty, and we have Johnson. These 3 persons come together. We open account in their names. Peterson's account, Johnson account, and Betty's account. Now, in each of these their account, every transactions around the partnership business is actually posted to this account. Every transactions, even the profit that they are going to get at the end of the day is there. That is where every transaction, anything that belongs to Peterson is posted to Peterson's account or is credited to Peterson's account. Anything that belongs to Johnson is credited to Johnson's account. Anything that belongs to Betty is credited to Betty. The balance of both fixed and current account introduced by the partners, number 1. Interest on fixed capital, number 2. Partner salary and share of profit are credited to the fluctuating capital account. That's what I just said now. That all of these transactions are debited to the, are credited to the capital account. The debit side will show only drawings and interest on drawing. What we are trying to say is that by the time you extract the statement of account for this particular account, you will see that the only debit transaction you are going to see represent the drawings made by the partner and the interest that is charged on the drawing. But on the credit side of their bank statement, you are going to see transactions like the capital that was introduced by the partner, the interest that is charged on this capital, the partner's salary, and then the profit that is accruable to this particular partner. Let's look at when it is just fixed capital account with current account. In this case now, 2 accounts are open in one person's name. Peterson's have 2 accounts, Johnson have 2 accounts, and Betty has 2 accounts. Now, the first account that is open for Peterson, that account is called fixed capital account. In that account, the only amount of money that is in that account is just the capital that was introduced by Peterson. And then a second account is also open in the name of Peterson. It is there that all other transactions like the share of profit, the interest on drawings, the salaries, all other transactions are there. And that is why it is called current. It is called current because it is that account that is used to foot the day-to-day activities of the business. I said here, the amount introduced into the business by partners will not change. The capital will remain fixed. Hence, a current account will be prepared. The current account will be debited with only drawings and interest on drawings and credited with the current capital balance. Interest on fixed capital, share of profit, and partners' salary. All of these are the transactions that you can actually find in your current account. So in this case now, the partners have two distinct or separate accounts. One is capital account, fixed capital account. It's called fixed because that money is not going to be touched. But the other side of it, the other account is current account where you can always collect money. Remember that it's just like a kind of an extension of our normal fixed deposits, savings account, and current account. When you open fixed deposit, you cannot take money at any time. You can only take money as an agreed date. And in savings, your money is there. You can take it at any time, but as long as the money is in the account, there is little or a very insignificant interest that will always be coming. But when it is current account, that current account is basically for business people. You can take money anytime. Instead of you to get interest, you will be charged with the bank services, So that is just an extension of what we are trying to explain here. Now, let's quickly look at how we can calculate interest on capital. Let's see how we can calculate interest on capital. Now, let's look at the illustration, the questions that is displayed here, and see if we'll be able to calculate capital, interest on capital from this. I know that students, it's not really difficult to calculate interest on capital, but for simplicity, it's important we mention it in this lesson, so that by the time you are given a question like this, you won't find it difficult to calculate interest on capital. Now, Peterson, Johnson, and Betty are in partnership. They shared profit or loss in the ratio 5:3:2 respectively. The partnership agreement contains the following. A, the partners' capitals are Peterson, $8,000, Johnson, $30,000, $80,000, Johnson, $30,000, Betty, $50,000. B, Johnson to receive a salary of $12,000 per annum. C, interest on capital to be 5%. D, interest on drawings to be 10%. In the year to 31st December 1997, the net profit was $60,000. The partners' drawings were as follows: Peterson, $14,000, Johnson, $10,000, and Betty, $6,000. The current account shows the following balances. Peterson is $2,000, Johnson is $400, Betty is $200. Now, if you observe beside Peterson's current account balance, you see CR. That CR represents credit balance. And then for Johnson, you see debit balance 400, and then for Betty, you see 200 credit balance. You are required to calculate partners' interest on capital. Now, why it is important for students to give an undivided attention to this is that students will ask, which of these accounts are we actually expected to charge the interest? Are we going to charge the interest on current account, or we should charge it on capital account? Remember, we have two accounts that is opened here. The first one is called fixed capital account, while the second one is called current account. Please, I want to emphasize that, please, you don't charge interest on current account. I want to say that again. You don't charge interest on current account. So from this question now, the only transaction we need to know the amount of capital contributed by each partner and the percentage that is allowed to charge on them. And that's all. Every other transaction you see here does not really mean anything to us. That's how serious this transaction is. Every other transaction you see here, they are just there. The only transaction we want to ascertain how much was actually contributed by each of these persons in their capital account. And then after that, we now look at how much percentage are we going to charge on them. So let's quickly do a very small arithmetic on the board to be able to explain what we are saying. Now, for Peterson, capital contributed. Yes, right? Capital contributed. Now, Peterson, how much did Peterson bring? Let's write Peterson. Peterson brought how much? $80. Peterson brought 80. And then Johnson. Johnson contributed what? 30,000. And then Betty is 50,000. All right. So the percentage, interest on capital to be 5%. So your interest on capital is what? 5%. So let's go for Peterson now. Let's go for Peterson. It's simply equal to 80. It's simply equal to 5% times. That's 5 over 100 times 80,000 over 1. We have a value there. So how much is it? 0 will cancel 0. 0 will cancel 0. You will be left with what? 5 times, you'll be left with 5 times 800, which will be equal to what? You use your mathematical set to be very sure of your answer. So you have 5 times 800. It will give you what? 4,000. So for Peterson, the interest on capital is 4,000. Then for Johnson, you have 5 over 100 times. How much is Johnson? 30,000 over 1. Here we cancel here. You'll be left with 5 times what? 300. Which is equal to what? Let's quickly use our calculator again. We have 5 times 300. It will give you 1,500. And then for Betty is still 5 over 100 times 50,000 all over 1. These two, we cancel these two, and then you'll be left with what? 5 times 50. 5 times 50, that will be 5 times 500 rather. That will be what? 5 times 500. That will be 2,500. That will be 2,500. So now look at the calculation we have on the board. We've been able to ascertain the interest on capital that is accruable for each of them. For Peterson, who brought 80,000, his interest is 4,000. For Johnson, who brought 30,000, his interest is 1,500. And then for Betty, who brought 50,000, his interest is 2,500. You can see now that the higher the capital, the higher the interest that is given to you. So this is how to calculate. At all time, whenever you are giving the capital contributed by partners and you are giving the interest on capital, please don't hesitate to charge the percentage on the capital. These are the figures that will now be posted to the partner's current account. All right, let's go to the drawings. We also want to look at drawings too and see how drawings can be calculated. Now, when we look at drawings, we said partners can withdraw at regular or irregular interval from the sum they are entitled to at the end of the year. Hence, drawing has to do with goods or cash taken from the partnership business for personal use. If the drawing is by cash, the total is credited to cash book and debited to partner's current account. But if they are goods, the worth of the goods is subtracted from purchase in the trading account and added to the total drawing to be debited to the partner's current account. I've already explained the concept of drawing, that whenever items, goods, or money is taken from the business for personal use. So whenever this is done, if it is cash, that amount of money will be credited to the cash book and the corresponding entry will go to the debit side of partner's current account. It will be subtracted from the take home for the particular partner. All right, let's look at the interest on drawing. The interest on drawing is simply the fixed amount or percentage that is charged on drawings made by partners in order to discourage or reduce the amount of cash or quantity of goods withdrawn. The interest on drawing will increase net profit and can be calculated on monthly basis. It can be calculated on monthly basis and it will increase. Now, the interest that is accruable from drawings can be added to the profit to increase our profit. So what we are trying to do, we want to explain or want to describe how to calculate interest on drawing so that by the time we prepare our account, our capital account, it will be very, very simple for us. Let's look at how to calculate interest on drawing. How to calculate interest on drawing. The following balances were extracted from the books of Tammy and Tessie for the year 31st December 1995. The partners' drawings of Tammy, $4,000. Tessie, $2,400. We are taking into 2 installments on 1st April 1995 and 1st October 1995. Calculate interest on drawing. Okay, now let's quickly look at how to calculate interest on drawing from this transaction we have here. Remember, we said this transaction is between Tammy and Tessie. So Tammy and Tessie, they are automatically partners. And then from what we are given here, they have their 2 drawings, different drawings, 2 installments. So let's start with first installment. This first installment is from 1st April to December, which is about 9 months. So for the first installment now, remember 4,000 is taken 2 times by Tammy and 2,400 is taken 2 times by Tessie. So what that means is that you are going to have for Tammy, you are going to have 9/12 times what? You are going to have 9/12 times 2,000. And then for Tessie, you are going to have 9/12 times what? 1,700. Is it 1,700 or 1,200? 1,200. How did I arrive at 2,000? Divide the 4,000 by 2 because the drawing was made in 2 installments. The first installment, he took 2,000 and he took it around April. So we are looking at it in the context of that year from April to December, April, May, June, July. Okay, April, May, June, July, August, September, October, November, April, May, June, July, October, July, August, October, November, December. Let's count it again. April, May, June, July, August, September, October, November, December. That's 9 months. So this 9 months is going to be 9/12 times 2,000. So when you use your calculator to manipulate that, 9 divided by 12 times 2,000, you are going to have 1,500, 1,500 for Tammy. And then for Tessie, you have the same value, 9 divided by 12 times 1,200. You have 900. Then that's for first installment. For second installment, for second installment, it is from 1st October. It is from 1st October. That is October, November, December. That's 3 months. You have Tammy. Tammy is 3/12 times 2,000. And then for Tessie, you have 3/12 times 1,200. So let's see. You have 3 divided by 12 times 2,000. You have 500. And then you have 500, and then 3 divided by 12 times 1,200. You have 300. You have 300. So the total draw interest now, that is the total interest on drawings now, the total interest of drawing for Tammy is equal to 1,500 plus 500. And then for Tessie is equal to 900 plus 300. So this one is equal to 2,000, and this one is equal to what? 1,200. So you can see now that from what is obtainable here, that means interest is 2,000 on the 4,000 that he took, while Tessie's own is 1,200. So that is how far you can actually calculate interest on drawing. This question is a very unique one because it is actually given based on, it was taken based on installment. And because it was taken based on installment, the calculation, there is no particular percentage. What we did here, we only used a month that was used. This one was done on monthly basis. From April to December is 9 months. That's why we have 9/12 times the first amount that was taken. This first amount that was taken, it was 1,500 that was charged on this first amount. And then the second amount is the second month was just 3 months. That is why it's 500. So if you add here to here, you have 2,000. If you add here to here, you have 1,200. All right. So far, can we just now look at let's go to our exam guide now to see if we can answer more questions to further explain what we have done so far. Now, I encourage students to always go to the exam guide. Whenever you are done with our lessons, don't hesitate to always go to the exam guide. The first one is talking about the liability. The partner whose liability goes beyond his capital is always a general partner. Let's just take at random. Let's look at question 8. Which of the following is not found in the partnership balance sheet? In the partnership balance sheet, you can see their capital, you can see their creditors, you can see their bank balance, but what is not shown in the partnership balance sheet is their drawings, because this drawing has already been taken care of in their capital account. So this capital balance is actually going to show you their position. The capital balance is going to show you how much each of them will be taking. So you will have both capital and current accounts. So what is not going to be there anymore is drawings. Let's take question 10. Agreement between partners is contained in the partnership deed, not partnership deal. Let's take question 20. An agreement made by partners to regulate and govern their business activities is known as partnership deed. Let's take 17, the last. A partner whose liabilities are restricted to the financial contribution to the partnership in the event of winding up is a limited partner. All right, so that's how far we can actually go. That's how much we can take.